Hello, everyone. A huge welcome to you all. And I just want to start by saying a massive thank you for coming to watch the video today. We know you have basically a practically infinite number of choices for financial news and analysis out there, so we genuinely appreciate you spending this time with us.
Yeah, absolutely. Thanks for being here, everyone. We've got a really massive update from the banking world today.
We do. We are doing a deep dive into HSBC Holdings PLC's 2025 annual results. The earnings call transcript just dropped, and it features Group CEO George Elhedery and CFO Pam. And they aren't just looking back at 2025, they're actually laying out a whole strategic roadmap all the way to 2028.
Right. It's a very forward-looking document. It's not just, a pat on the back for last year.
Exactly. So just a quick heads up on the structure for today's video. We're going to start with the big numbers and the general strategy from their prepared presentation. Then we're going to really roll up our sleeves and get into the Q&A session, which, let me tell you, is where the analysts really tried to hold their feet to the fire in the details.
Oh, they definitely did. The Q&A is always where the real story is.
For sure. But let's set the stage first. 2025. How did they actually do?
In short, they had a record year. I mean, the core message from management was that 2025 was a year of, and I'm quoting here, performing, transforming, and investing for growth. And honestly, the numbers back that up. They hit a record profit before tax, or PBT, of $36.6 billion.
Wow.
Yeah, that's up 7% year over year. Revenue grew 5% to $71 billion.
$36 billion in profit. It's kind of hard to wrap your head around that level of scale. But for investors, the metric that usually really matters here is the return on tangible equity, right? The RoTE.
Exactly.
And just to pause for a second, for anyone who isn't staring at bank balance sheets all day, RoTE basically measures how efficiently the bank is using the shareholders' money to generate that profit. So what was the number there?
They hit 17.2%.
Which is huge.
It is. For a global, systemically important bank, that is a very, very strong efficiency number. And because of all that cash generation, the shareholders are getting a nice bump too. The full-year ordinary dividend came in at 75 cents per share, which is a 14% increase from 2024.
Okay, so clearly making money isn't the problem for them right now. But you mentioned that buzzword, transforming. What actually shifted strategically last year?
Well, the biggest piece of the puzzle, without a doubt, was the completion of the Hang Seng Bank privatization. That was a $13.7 billion deal.
Right, to buy out the rest of it.
Exactly. And the strategic goal there is to combine HSBC's massive global reach with Hang Seng's really deep local roots in Hong Kong. It's all about streamlining operations in that critical market.
Streamlining. Yeah, and speaking of that, I saw some notes about simplification in the transcript. Usually when executives say simplification, that's just corporate speak for cutting jobs, isn't it?
You're not wrong. They did reduce net managing director positions by about 15%, but it's broader than just headcount. They're aggressively restructuring, pulling about $1.8 billion in costs out of non-strategic areas and reallocating that money directly into growth opportunities.
Okay, so if they're cutting MDs and pulling back in some areas, where is this growth coming from? Where are they placing their bets?
Wealth management is the big star here. Revenue and wealth was up 24%. Transaction banking was also up 4%. Geographically, they're really doubling down on what they call the Asia-Middle East corridor. And interestingly enough, UK business banking was a highlight where lending grew by 13%.
That Asia-Middle East connection is something we keep hearing about across the sector. Now, before we jump to the analysts' questions, we have to talk about the buzzwords of the decade, technology and AI. I mean, is HSBC actually doing anything real here, or is it just a slick slide in their pitch deck?
It actually seems pretty concrete. They're adopting generative AI across 3 specific work streams. First, empowering colleagues with things like coding assistance. Second, process reengineering, specifically speeding up KYC, the know your customer onboarding stuff. And third, customer experience.
Okay, that makes sense.
But here is the kicker, and they used a very specific word for this. They demised over 1,100 legacy applications.
Demised sounds so final. Like they took the old software out back and...
Basically, yeah. They sold them off. It's about getting rid of that old tech debt to fund and make room for the new stuff. And all of this restructuring and tech investment feeds directly into their new targets for 2026 to 2028.
Right. Let's hear the targets.
They are aiming for revenue growth year on year, scaling up to 5% growth by 2028. They want to keep that return on tangible equity at 17% or better every single year, and they're targeting a dividend payout ratio of 50%.
Bold targets. But, targets are easy to set on a stage. Hitting them is the hard part. And I think this is where it gets really interesting for us, because let's move into the Q&A session. This is where the analysts from the big firms got to poke holes in all this optimism.
Oh, yeah. And they went straight for those revenue targets right out of the gate.
Yeah, the very first question came from Nick Lord at Morgan Stanley. He essentially asked, all right, you have this 5% revenue growth target by 2028. What are the actual components driving that? And is this massive growth we're seeing in wealth and markets in Asia actually sustainable?
Which is a totally valid skepticism to have. Like, is this structural growth or just a lucky market cycle?
Management's response, and both George and Pam weighed in here, was that the growth in 2025 was broad-based. It wasn't just one lucky bet on fees. It was deposits, loans, and fees.
They argued their footprint is just in the right place at the right time. Exactly. They said their footprint aligns perfectly with structural growth areas. They specifically used the phrase Asia buying Asia and highlighted that Middle East integration we talked about. Plus, they pointed out the UK seeing its strongest loan growth in years to show it's not just an Asia story.
Though they did temper expectations a bit for 2026, didn't they? They admitted that banking net interest income, or NII, might only see low single-digit growth next year.
Yes, but they expect the strong momentum in fee businesses like wealth and transaction banking to carry the torch while interest rates settle.
Right. The next up was Joe Dickerson from Jefferies, and he looked at the other side of the ledger, the costs. He asked about their target to keep cost growth at just 1% for 2026. His worry was basically, does that leave enough room to invest in things like AI when all your peers are spending heavily? And he also threw in a technical question about their HIBOR assumption, the Hong Kong rate.
That's the classic don't starve the future to feed the present dilemma. But George and Pam were very confident here. They said the bank has ample capacity because they're recycling those savings. Remember the $1.5 billion in simplification savings and the $1.8 billion from reallocation.
Right, finding money in the couch cushions.
Exactly. Billion-dollar cushions. They're recycling that directly into AI and tech. And they noted they are actually ahead of schedule on those simplification savings. As for HIBOR, they said their assumption uses the end of January forward curve, and that volatility has largely stabilized around 2.5%, which is fully captured in their guidance.
Okay, then we had Ben Toms from RBC. He zeroed right back in on that 17% RoTE. He wanted to know if that's sustainable beyond just this 3-year planning horizon. And he also asked for some clarification on the Hang Seng deal, specifically why management split the benefits into $500 million of synergies and $400 million of upside.
Yeah, that terminology is tricky. Management called the 17% target ambitious, but they are fully confident in it for the 3-year plan. Regarding Hang Seng, Pam explained the split is basically due to accounting rules.
How so?
The $0.5 billion in synergies are reported synergies that fit strict accounting definitions, hard, measurable cost savings. The $0.4 billion upside is revenue they fully expect to capture based on market behavior, but they just can't officially book it as a promised synergy on a balance sheet yet. But they noted the $0.6 billion in restructuring costs their spending covers, achieving both of those buckets.
Got it. Then Melissa from Goldman Sachs stepped up to the mic. She wanted the math. She asked for a compound annual growth rate at KLIRA-GR on that revenue path, and she pushed harder on those restructuring costs, asking what exactly is that $0.6 billion being spent on. Plus, she wanted to know the timing of those revenue synergies.
This was a really crucial clarification from Pam. She stated that revenue growth will be progressive over the period, but on the restructuring costs, she was crystal clear that money is largely for technology harmonization and organizational alignment between HSBC and Hang Seng. It is explicitly not for severance or redundancies.
Which is a huge distinction. Usually, as we said earlier, restructuring means layoffs. Here, she's saying it means wiring the IT systems together.
Right. And on the revenue synergies, she explained they come from removing arm's length restrictions. Basically, now that HSBC fully owns Hang Seng, combining the red brand and the green brand, they can offer better global product propositions like wealth and capital markets to Hang Seng customers without the previous legal friction.
Makes total sense. All right, moving on, we had Aman Rakkar from Barclays. He shifted gears to capital and CET1 ratios. He essentially asked, could you restart share buybacks earlier than the projected 3 quarters? He also asked about some one-offs in the NII and their deposit assumptions.
Buybacks are always the hot topic for investors because it boosts the share price. But management held a very firm line here. They said the absolute priority is restoring the CET1 ratio which obviously took a temporary hit from buying Hang Seng. They do decide on buybacks quarterly, but very strict criteria apply.
And what about the NII one-offs?
They confirmed there was about $100 million in non-repeatable items in Q4 for the NII, and on deposits, they expect deposit growth to remain a key driver in 2026, working alongside a tailwind from their structural hedge.
Speaking of targets again, Amit Goel from Media Banker had a really sharp, clarifying question next. He asked, does this RoTE target imply things keep improving year on year, or are you just happy treading water as long as you stay above 17%?
Mm-hmm.
And he also dug a little deeper into that Hang Seng upside bucket.
Pam played it very straight here. The target is simply 17% or better each year. There is no specific upward trajectory promise.
Just hold the line at a high level.
Exactly. On the Hang Seng upside, she reiterated that it includes revenue benefits that get a haircut in strict accounting reviews, but stressed that they are backed by highly detailed internal execution plans. And again, she took the opportunity to reconfirm that the restructuring spend is on tech and upskilling, not layoffs.
They really wanted to hammer that point home. Then Kian Abu Hussein from JP Morgan came in with a two-parter. First, he wanted the gritty details on the tech stack, like where are you on cloud and Gen AI? And second, he asked about their comfort level with Hong Kong commercial real estate coverage ratios.
Yeah, that second part is the elephant in the room. But on the tech, George took it and got to brag a bit. He reiterated demising those 1,100 non-strategic apps out of roughly 3,000 total. For Gen AI, he pointed to three things: colleague enablement with coding assistance, process reengineering for KYC, and overall customer experience.
And on the real estate.
Yeah.
Because the Hong Kong property market has been under immense pressure.
Pam handled that one. She said their guidance of 40 basis points for expected credit losses, or ECL, fully covers it. She gave some hard numbers, too. China commercial real estate exposure is now down to less than $1.5 billion, and Hong Kong residential is normalizing.
But what about the office sector?
Right. The office sector vacancy in Hong Kong is high, around 17%. But she clarified they only focus on credit-impaired names with loan-to-value ratios over 70%. That specific high-risk exposure is $1.9 billion, and they already have $900 million set aside in ECL coverage for it, so they feel very comfortable.
They built a massive buffer. Next up was Rob Noble from Deutsche Numis, who played the skeptic. He asked about the negatives in non-interest income for 2026, basically asking, why are you being so cautious on revenue? He also asked about the difference in capital requirements between the UK and Hong Kong post-transaction.
Management's response to the revenue caution was basically, we'd rather be safe. Transaction banking and wealth are performing beautifully, but they have to be realistic about market volatility affecting fee income in 2026.
Underpromise and overdeliver.
Precisely. And on the Hang Seng Capital side, they explain that fully owning it removes a $3.8 billion minority capital inefficiency. It basically unties their hands, giving them much greater flexibility to move capital upstream or downstream within the whole global group.
Then Jen Li from China Securities asked a very targeted strategic question. Which specific aspects of wealth management will actually see the strongest synergies with Hang Seng Bank?
It's all about access and scale. George and Pan explained that Hang Seng will absolutely retain its brand, its branches, and that crucial community focus. The synergy doesn't come from rebranding. It comes from back-office efficiency and the new ability to sell the full, massive suite of HSBC global products like cross-border wealth and capital markets to those local Hang Seng customers without the old restrictions.
It's the best of both worlds. A trusted local face with a massive global engine behind it. Then Ed Firth from KBW asked if the Q4 HIBOR benefit to NII was just temporary. And he pushed on the timeline, asking why they are so confident in 5% growth specifically in 2028 rather than sooner.
Pam stepped in to say HIBOR has largely stabilized in that 2.25 to 2.5% range, and again mentioned the structural hedge providing a reliable tailwind. As for 2028, she clarified it isn't a magic year.
Right.
It just reflects the timeline of the long-term structural opportunity after they navigate the near-term headwinds from falling interest rates over the next couple of years. They deliberately prefer cautious guidance that bakes in downside scenarios.
Okay, getting near the end of the call, Alistair Wall from Autonomous asked about potential asset quality upside in Hang Seng, essentially. Are they just being patient and waiting for the property cycle to turn? He also pointed out a noticeable slowdown in new account openings in Q4.
Pam admitted that, yes, they do expect asset quality improvements as the credit cycle eventually normalizes. But her answer on the new accounts was really revealing. They had 1.1 million total new-to-bank customers for the year, which is huge. But that Q4 slowdown, it was entirely intentional.
Intentional. Why slow down growth?
Because they introduced fees for low balance accounts, specifically those under 10,000 Hong Kong dollars. They did this to intentionally shift their acquisition focus toward the much more profitable, affluent, and premier segment.
Ah, so chasing quality over quantity. That makes a lot of sense. Then Kendra Young from CICC zoomed all the way out to the macro level. She asked about the assumptions behind all this guidance, specifically regarding Federal Reserve rate cuts and balance sheet reduction.
Pam emphasized that their guidance relies on plausible downside scenarios. They aren't assuming a perfect macro environment. The guidance accounts for the January forward curve, which already prices in rate cuts in both the U.S. and the U.K. Despite tariffs or shifting trade policies, they believe the business is highly resilient because of their growth in targeted corridors like Hong Kong to the U.K. and Asia to the Middle East.
And finally, Catherine Lay from JP Morgan wrapped up the whole session. She asked about the sustainability of deposit growth, especially considering tax changes and flows in China, and how that impacts the wealth business.
George took this final one. He really stressed that their wealth strategy is highly diverse. It is not solely reliant on cross-border flows from mainland China. They're building onshore in China, in India, and Singapore. He referred to deposits as their anchor of trust, noting they have surplus liquidity in every major currency.
A good problem to have.
Very much so. And Pam backed him up, pointing out that deposit growth was robust across all sectors: retail, premier, and private banking. And that broad base is what underpins their confidence in banking NII for 2026, even with the interest rate headwinds.
Wow, okay. That was a marathon Q&A session. They really covered the entire waterfront there.
Yeah.
So if we take a step back from all these basis points and billions, what is the high-level wrap-up? What are the main themes from this presentation for someone watching?
I think you can boil the whole deep dive down to 4 main themes.
Okay, let's hear them.
Theme 1 is financial strength. You just can't argue with record profits and a firm commitment to high returns at 17% plus RoTE and growing dividends. The engine is producing cash.
Right, and theme 2.
Strategic focus. Management kept repeating that perform, transform, invest mantra. The Hang Seng privatization is a massive, decisive pivot to consolidate their leadership in Hong Kong and Asia. They are simplifying the corporate structure to move faster.
Makes sense. Theme 3.
Tech and efficiency. They aren't just trimming around the edges. They are retiring legacy systems to aggressively fund generative AI. Demising 1,100 apps is a clear signal that they are deadly serious about modernization.
And the final theme.
Cautious optimism. Management is clearly confident in their long-term structural growth, hitting that 5% by 2028. But they remain incredibly disciplined about near-term risks, whether that's falling interest rates or commercial real estate. They're planning for the downside while building for the upside.
Which is exactly what you want a systemically important bank to do.
Right.
Right. You want them steering the ship very deliberately through whatever waters come next. It almost makes you wonder, as they demise thousands of legacy apps to fund Gen AI, are we reaching a point where these mega banks are just massive tech companies that happen to hold banking licenses? Something for you to chew on.
It's a fascinating thought.
Well, that brings us to the end of our deep dive into HSBC's 2025 results. Thank you all so much for watching the video today. If you enjoyed this breakdown and want to see more content like it, please click like, share the video with your network, and subscribe to the channel. Yes, please do. And stay tuned, because we will definitely have more upcoming content analyzing the biggest moves across the market. Thanks again, everyone. See you next time.